This company, which is Affirm, today is up over 4%. Now, today is a day where the broad market is up nearly 2%, and the Nasdaq, I believe, is up 2.5% as we speak. But I was gonna give you my honest thoughts on Affirm. I've been wanting to make this video quite a bit now. Over the past year is up to 40%. Now this company in November was about $40 a share, and it was all the way up to $72 a share. Now this is only 1 month. Of course, there was the Trump's rally. Definitely this company participates to the Trump rally and Santa Claus rally, and usually November and December they're good months for the stock market, generally speaking. But over the past 5 years, you can see like it used to be $150 stock and over at the end of 2021 with all the euphoria, and then the huge drop. Now I do believe that this is actually where the company stock price is gonna go back to. It's gonna drop a lot. I wouldn't be surprised it's gonna half this. This seemed to me like a little bit of the short sellers covering. It could very well be. I would also say that this is a fairly new stock because it only went public, I think, January 11th, or around January 11th, 2021. This is typical of euphoria, boom. Also, the euphoria being an IPO. But I definitely believe that this company is gonna go back to what's really worth, which is much less than the 55 or 57 and 55 that is trading today. Now let's see. It's got a 5.5% of the float shorted. Here also the seeking alpha analysts, they're giving a hold. Wall Street a buy, and the quant rate him a hold. The valuation at D. Growth. This is possibly the revenue growth. A plus, profitability a C. Momentum right now, it's got a good momentum in the revisions. Let's see. This is of course a company in the buy now, pay later sector. Basically, it's in the financial sector. What else? Here, the seeking alpha analyst rating once again. Basically, it's a hold. And Wall Street 7 on a hold and 7 on a strong buy. Anyways, I don't usually pay much attention to what the analyst is saying. Actually, in most cases, I do the opposite. But it's good to see what they're saying. Now, this company's got over 2,000 employees, founded in 2012. Revenue estimate is growing. EPS estimate, they're still losing money in 2025. The estimate, but eventually it could be that they're gonna break even. I don't know how long that is gonna take. Definitely they have a lot of expenses, but for right now they're losing money, and they're gonna keep losing money. Revisions 30% down, 70% up. Now this company, of course, they're negative on the net income, about 17 to 18% negative. Return on equity negative 16.5%. Return on asset negative 4.5%. Market cap 17 billion. Total debt over 7 billion. They got about 2 billion in the bank. And the enterprise value is actually 22 billion. Now I'm curious to see how they came up with that 22 billion. Those are the peers. Toast, Copay, Shift for payments. There are no really recent news on this stock. January 8th was the last one. Let's see on the news. Of course, here JP Morgan calls it a long-term secular winner. I was raised to market outperform. I don't doubt that the company has a good future ahead of it, but I don't think that the stock is priced right. I do believe that the stock is high priced. Now notice, I did not say overpriced. I am nobody to say that a stock is overpriced or underpriced. That is recipe for disaster. But I can make a statement that in my opinion, this stock is high priced. And actually I have it down to 25 or less. Now it also depends on all the broad market does, but I do believe that this stock is gonna come down a lot. Let's see on here is macro trends, another one that I used to pick stocks. Usually assets and liabilities. It's good to see how much cash they got on hands. And no surprise, they got about 2 billion in the bank, according to the latest report. Now, macro trends is not always updated, but it's good to see what is the general trends. So this company's got 2 billion and 7 billion in debt. Now, this is long-term debt, but this is a worrying trend that it seems like every quarter they're gonna put more debt on their balance sheet. I'm not a big fan of that. I mean, it depends on what they do with the debt. Let's see the shares outstanding. And that's it appears that they're slowly diluting the shareholders. Not by a lot, but definitely this is not something that I want to see. That quarter after quarter, basically they dilute the shareholders. Not a big fan of that either. On the financials, like I was saying, it's got a good increase in revenue year after year, which I like. Now, of course, on the net income, this company loses a lot of money. In fact, they're losing. Last year they lost over $500 million. The year before, nearly $1 billion. Now, of course, I understand that the company is still new. They're trying to grow, and it is normal losing money at such an early stage. Let's see the price ratio. See here, PE ratio negative, of course, because they lose money. Price to sale. Price to sale is nearly 7, which is quite a bit. Pretty much since 2022, pretty much it's one of the highest price to sale ratios in its history. So another reason to stay away. Price to book 6 times, which is a lot. Actually, I believe that this price to book is a little too much for me. 6 times price to book, which is again one of the highest in its history. 6.06. Now, of course, this you have to go back to 2021, where all the euphoria was taking place to come up with a higher price to book ratio. Let's see the price to free cash flow, but of course that I believe is because they have no free cash flow. But according to this, it's 45. 45 price to free cash flow. It's too much. It's too much. Never buy a company that's got over 40 price to free cash flow. It's too much, and especially in this sector, in this industry, it's definitely too much. Now, of course, if you're buying a semiconductor company or a AI company, one of those disruptive companies, it could be that you have to pay those multiples. But for a company in the financial sector, I don't see it. It seems a bit too much for my taste. Now here, this I was gonna look at the insider trades right quick. The insider trades. Basically, all of those insiders are selling. They were selling a 62, a 62, a 72, 68, 68, 72 bucks a share. Possibly because they felt it. The stock price was ahead of itself, and that's why they sell it. Now, those are all the recent transactions. This is from January 2nd, 2025. But they were already selling, of course, in 2024 when there was the craziness in the stock market, November, December, and basically they're all selling. I mean, you can go back to March 2024. The directors, the insiders, CFO, the president, they're all selling. Of course, there are several reasons why they can be selling shares, but for me, it's a red flag. So I wouldn't buy this stock anytime soon. When it comes to the ownership, nearly 70% institutional. Let's see here. There is not a lot of transactions on this. Bailey and Gifford, they are the major stakeholder with nearly $500 million, but the past quarter they reduced their position by over 25%. So that's gonna tell you some. Among the others, Charles Schwab, Bank of Montreal, Swiss National Bank, Soros Capital Management. It's about 1% of the portfolio of Soros Capital Management. Short interest, they got about 6% of the float shorted. Of course, this fluctuates quite a bit. It depends on the market condition. It also depends if the short sellers are covering. Next, I was gonna pull up some of the video reviews about buy now and pay later. I think the whole thing is they're like a middleman. They're trying to make a cut. But I want to show you. I come up with some good videos. Let's see what it's saying.
So like the old saying goes, if something sounds too good to be true, then it probably is. And in this video, we have to talk exactly about how this applies to buy now, pay later services, and why I think you really should just try to avoid payment options like Affirm, Afterpay, and Klarna altogether. Now, I think it makes sense why buy now, pay later has become so popular lately, because it really does sound like a good deal at first, right? Instead of buying something at full price up front, you can just split that up into 4 easy payments over the course of 6 weeks and even pay no interest. That way you get to enjoy your purchase now and pay it off in a way that maybe seems more manageable for your budget. But really, when something is being marketed as being this good to you, there's usually a catch to it. And I think that as we dive a little bit deeper into these buy now, pay later services in this video, you'll start to see the truth about why they can actually be a big problem for a lot of people, especially right now in 2022 as everyone's cost of living continues to rise with elevated inflation. So let's get right into how buy now, pay later works so that hopefully you can actually avoid some of the hidden tricks that these companies are using to make money off of you. Now, I'm going to start off this video by jumping over to a retail website like Nike.com. That way we can quickly go through what the buy now, pay later process looks like when we're buying something like a pair of sneakers. So here on Nike's website, I'll just go ahead and add this random pair of sneakers to my cart that have a price of $160. And then when we go over to my cart right here, we can see this option to use Klarna, which is one of those buy now, pay later companies that I mentioned. Now it says 4 interest-free payments, so that usually gets people's attention. And then when they select this option, it says that for this $160 purchase, Klarna will allow us to split it up into 4 equal payments of just $40 each. We'd make our first payment of $40 today, and then another $40 payment every 2 weeks after that. So then at the end of 6 weeks, we would have paid a total of $160 with no interest. So that sounds pretty good, and it's kind of hard to believe that these buy now, pay later companies are even making money if there's no interest. But I'll explain some of the smart ways that they've figured out how to profit from this sort of model, because it's really interesting how it all works. Now, technically, you could use a credit card to buy something like this in a similar way, because there are time frames within a credit card billing cycle and the payment due date that can give you a few weeks to pay off your balance without any interest as well. But for some people, credit cards have become associated with getting into debt, and plus it takes maybe between 7 to 10 days to open and then get a new credit card in the mail before you can even use it. So these buy now, pay later options seem easier because they're what's called point of sale loans, where you get approved for this mini installment loan on a case-by-case basis, and then you actually get to walk away with the item you want to buy today, which gives you that instant gratification. Now, some people try to make the argument that using buy now, pay later services actually makes sense financially, because if they buy at 0% interest, they can then go ahead and invest their extra cash that they don't have to pay up front. That way they can supposedly profit from a spread between their investment return and the 0% interest on the cash they're holding onto. But don't buy into this idea, because are you really going to invest that extra $120 that you don't have to pay today in that Nike sneaker example, and then every 2 weeks withdraw $40 from your investment to make that payment? And also remember that 6 weeks is such an incredibly short period of time to get any sort of a return, so the odds of your investment going up or down are probably close to 50-50 anyway, so it just isn't realistic. Alright, now next here we have to talk about why buy now, pay later has become so popular lately and is now being offered by pretty much any retailer you can think of. So one reason that companies like Nike from that example have begun to offer buy now, pay later as an option is because there seems to be evidence that not only does splitting up this purchase price over time actually increase the average order size from their customers, but it's also been found that these payment services help to increase conversions, meaning that the customers are actually more likely to go through with a purchase when buy now, pay later is available, instead of just adding something to their cart and then abandoning their cart entirely without a purchase. So ultimately that means that these increased sales for retailers is really coming from customers that are unknown unknowingly spending more compared to what they would normally spend with more traditional payment options like cash, a debit card, or a credit card. Now, obviously, retailers like to see higher sales and better conversions. Plus, right now, they especially like to see this stuff because, again, with inflation making all these living costs and anything else more expensive, that typically can lead to less consumer demand and less discretionary spending at places like Nike. So buy now, pay later can sort of act as another tool that companies can use to give a little push to their customers to just keep spending away, because payment plans can sometimes make it harder for people to understand what they can afford and what they can't afford. We can even think about this with a similar but more extreme example when someone is buying a car. So if you saw a car for $20,000 that you want, you probably either don't want to pay that or can't afford to pay that full $20,000 price up front. But let's say instead you could finance it at 5% for 36 months. That would give you a monthly payment of around $599, but maybe even that monthly cost is a little bit high for your budget. So to make it sound more affordable, the dealership might stretch out that purchase even more for you by saying that you could finance it for 72 months at that same 5% interest rate. Now your payment is only around $322 per month, so the car might feel more affordable to you, even though you're still buying the same $20,000 car. And actually, by stretching out that loan, now you'll pay twice as much in interest over those 72 months compared to a 36-month loan. Now back to buy now, pay later. Even though there's a 0% APR for most of these short-term 6-week payment plans, the psychological trick is still basically the same because all these plans stretch out your payments to make something seem more affordable. And also, many of these companies do offer additional longer-term financing options for maybe 3 to 12 months that actually have high APRs that are similar to credit cards. So I think the trouble with buy now, pay later services is that they can become sort of a game of debt accumulation that not everyone is fully aware of, since it's being marketed as a way to pay that's more affordable or smart or not breaking the budget. But honestly, that's a dangerous way to look at it, especially since a large portion of those that use buy now, pay later might be more likely to be living paycheck to paycheck, so that could lead to some missed payments and late fees, which is one way that these companies are making money. Now, another really important thing that we have to talk about here is related to the tendency that many people have to want instant gratification with things. This is one reason why buy now, pay later can be the perfect trap for people to spend money on items they might not actually need. And actually, if we take a look at any of these websites of buy now, pay later companies, we can see that they all talk about the retailers that they partner with. Almost all of them are selling mainly discretionary items that are more of things we might want, but not really items we always need to spend money on. So that could be
I agree with him 100%.
EVs, electronics, new clothes, or even different types of travel. Now, I do realize that not everyone out there is purely using buy now, pay later for discretionary things they want to have, because I know there's a ton of people out there living paycheck to paycheck that are using these services to pay for necessities like food or household items or even things their kids might need for school. So in these situations where cash is tight and some people really have to pay for something they need without paying in full, I'd say that using buy now, pay later is an okay option, at least in the short term. But I'd say that the only way to use buy now, pay later effectively is to not make it a part of your long-term financing solution. All it takes is for several of these loans to add up, or for you to lose track of just one, or maybe your income decreases for some reason, then you could fall behind on a payment and get charged late fees, or even start to damage your credit. Some of these
possibly there are people that are already maxed out with the credit card, so they can even get a minimum credit from their bank or from their lenders, so they're gonna turn into buy now, pay later. Now then, I want to show you too, in the meantime, some of the comments below. They're actually positive comments, but again, those are people that they want to buy things that they cannot afford.
These buy now, pay later plans might only do a soft credit check when you apply that won't affect your credit score, and they won't always report on-time payments, but late payments after a certain time could get reported to start to hurt your score. So just do your own research on what payment plan you might be looking to use and the implication of using that, because none of this is financial advice. It's just my own opinion as someone that's interested in this stuff. But I think the best plan when using buy now, pay later for necessities is, first of all, to stick to a budget. That way you're not buying stuff you don't actually need and you're not accidentally overspending. And then second of all, you really should be actively working at the same time to put some money away in an emergency fund. That way you can create that margin of safety, and then you'll be much less likely to have to turn to any type of consumer debt in the future just to make ends meet. Now, there's actually another strategy for taking advantage of buy now, pay later plans that I think is much healthier, that also allows you to pay for things with 0% interest, and that is a method that we can call save now, pay later. Now, I'm definitely not the first person to come up with this, because basically it's like how we all saved money as we were growing up as kids by saving giving up things like birthday money and allowances. But if you can't afford to pay for something in cash right now and it's not an absolute necessity that you need to have today, just try to fight that urge for instant gratification and save up for a purchase instead. So with that Nike sneaker example, if you can say to yourself, okay, I can wait to get those sneakers in 6 weeks and all I have to do is set aside $40 today, and then in another 2 weeks when another paycheck comes in, I'll set aside another $40 and then another and another until I have that full $160 saved up. And only then you can go to Nike and buy those shoes. You basically did the exact same thing as buy now, pay later. The only big difference is that you get the shoes 6 weeks later because you had to wait and delay gratification, and that's it. Again, using buy now, pay later for necessities is one thing, and I get it by turning to alternative payment options to make ends meet, but these point of sale loans really seem to be targeting Gen Z and younger generations, along with their need to buy things to impress others. With save now, pay later, you don't have to worry about missing payments and those late fees, and you're also not helping to fuel the new buy now, pay later trend, which could be bad for prices in the long run because of the main way that these companies actually make money. And I have to touch on that last here because it's actually really interesting. So I said before that there seems to be evidence that buy now, pay later purchases can have higher order sizes and higher conversion rates on average, but we also have to consider what retailers like Nike are paying companies like Klarna to get these things. Now, when we pay for something with a credit card, usually it's going to be more costly for retailers than if we use cash or a debit card. And that's because in order to accept these credit cards as a method of payment, retailers have to pay those credit card companies what's called interchange fees, which can be maybe 2 to 3% of the purchase price, but it varies depending on the credit card that's used. Compare that to paying in cash or with a debit card, there's really not much of a transaction cost there, probably not zero, but it's basically very little. Now, since credit cards are really the dominant form of payment and retailers need to accept them for business, they need to do something about those extra 2 to 3% fees because their profit margins are already pretty thin. So what they do on average is usually they increase the prices for the things that they sell to reflect those higher transaction costs, which means that the costs of those credit card interchange fees are basically passed on to the customers to some degree. Now, the reason I'm mentioning this here is because buy now, pay later works as sort of another payment option that's growing in popularity, and there's a similar cost for retailers to accept it. So buy now, pay later companies essentially run like a salesperson that gets paid a commission, because when customers see the logos for Klarna or Afterpay at checkout, they seem to be much more likely to make a purchase and their orders are larger on average.
That's exactly what I was saying, is that they make a cut. It's almost like a middleman. It's almost like a sales guy working for Nike or Shein. It's much easier that a buyer makes the purchase if there is the buy now, pay later logo.
And retailers pay companies like this for helping to generate the sale, but instead of maybe 2 to 3% fees that retailers pay for accepting credit cards, the average buy now, pay later fees might be closer to 4 to 6% depending on different factors. So in that $160 sneaker example, the way it would look is that Nike would say, thanks Klarna for getting this person to buy our sneakers, and then essentially Nike would generate revenue of $160 from this purchase, minus maybe a 5% commission of $8 that Klarna would get for helping to make this sale. So really, Nike is only making $152 instead of the $160 they would have received if someone paid cash for these sneakers in one of their physical Nike stores, and that means they would have a slightly smaller profit margin from the sale. Now, of course, they can afford that. However, if we amplify this type of spending behavior across tens of thousands of retailers and tens of millions of customers as buy now, pay later becomes more common, then it's not unreasonable to think that eventually companies like Nike would just pass on more of these costs to their customers over time. Or maybe they would make some other adjustments and not give employees proper raises, or they'll cut costs in the supply chain or some other areas. Now, this is all just an oversimplified example to make a point, but what I'm trying to say is that just because you see those words for 4 interest-free payments at checkout, somewhere down the line, someone has to be paying extra for buy now, pay later companies to make any money, and because they're a consumer-facing business, those extra costs are going to get passed on to consumers in one way or another. Now, I want to know, have you ever used buy now, pay later before, or do you think you ever would? I know I haven't.
I believe he hit the nail around the head with this video. Now, there was, I don't know, there are some videos of, let's see, this one, or reviews. But really, I was interested to know in more detail how Affirm makes money. Of course, they make a little cut, and they charge the consumer.
Yo, this your boy Really Resilly, and you're now building credit with Really Resilly. So today we're going to talk about an account that you can add to your potential profile, and that account is Affirm. Affirm is a buy now, and everything was just so easy and simple to understand. What I do like about Affirm is you're able to pay with your bank account, and you can do auto pay, or you can pay with your debit or credit card. With Affirm, it does report to the credit bureaus, and actually I want to cut off that S on there because it reports only to Experian. Another cool thing I like about Affirm,
They only report to Experian.
is they actually let you know what your interest rates is going to be up front. So in my opinion, the interest is kind of on the higher end, but it just depends on when you pay it off. So the more monthly installments, the higher the interest. The less monthly installments, the less the interest is. So that's one thing I do like. Everything is up front and straightforward and it's easy to understand. So with Affirm, they also do have the option to actually go into the actual retail store and actually purchase the items that you want to purchase. So the way this is executed is with a virtual credit card. So pretty much once you get approved and you go through all the steps, they're going to give you a virtual credit card. And then once you go to the actual retailer, like you go into the store and get the items you want, you're going to use that virtual credit card at the merchant machine. And once you actually buy the items, it's going to be approved. So once you scan everything and you buy it and the transaction goes through, that's when your loan details will be emailed to you. So it reports to your Experian credit bureau as an installment loan. So this is a good way to build your credit, depending on how many installments you have. Make sure you make your on-time payments, because if you don't, then you get a late payment, and then this can actually destroy your credit. So never allow yourself to get a late payment. That's like one of the worst things you can do when it comes to building credit. A potential con or the downside of Affirm, I would say if you're a shopaholic or you don't have discipline or self-control, I wouldn't recommend Affirm, because you can get approved for more than one loan, and sometimes people overdo it and they get behind. So if you just make sure, if you're going to use Affirm, just make sure you're in a financial situation to pay these.
That's exactly the problem, is that people are going to overdo it. But anyways, what else is in here? The reviews. This telling.
Hi everyone, in today's video we'll be talking about the Buy Now Pay Later app Affirm. We'll be looking into what Affirm is, how it works, applying to use it, benefits of using the app, managing payments, plus safety and security. Whether you're planning a big purchase or simply looking for a convenient and flexible way to pay for everyday items, Affirm is an excellent option. Buy Now Pay Later is a financing method that more Americans are using to make discretionary purchases, especially online. At least 39% of consumers have tried this option, also known as a point-of-sale installment loan, at least once, according to a 2021 survey by the Strawhecker Group. So, what is Affirm? Affirm is a financial service that allows you to pay for your purchases over time without any hidden fees or compounding interest. With Affirm, you can split your payments into smaller installments and pay over a period of time that suits you. This means you can enjoy your purchase now without having to worry about a large upfront cost. Every Buy Now Pay Later provider works a little differently, though the basic premise is the same. At the checkout point, under payment options, you are offered the option to spread out the payments for whatever you're purchasing. You apply and are usually approved in seconds for what's basically a short-term loan. You make a small down payment, then agree to pay off the rest of the installments over a few weeks or months. The way that Buy Now Pay Later programs like Affirm work, the merchant is not offering you this credit. Instead, a third-party lender that has partnered with the merchant is providing the credit. Affirm is one of these third-party lenders. Affirm is designed for financing purchases when shopping with partner merchants, though some platforms that offer short-term installment loans also offer bill payment services or money transfer services. Affirm isn't one of them.
With some point-of-sale loans, your payments are automatically divided into 4 installments. Specifically, that means an initial down payment at the time of purchase, followed by 3 additional installments. Affirm, on the other hand, works by allowing you to choose your payment option. So, for example, you may be able to split purchases up into 3 payments, 6 payment, 7% for credit card accounts as of November 2022, according to the Federal Reserve data. Affirm could thus be a less expensive option if you qualified for 0% financing, but if not, then it's possible that you could end up with high interest rates compared to what you might pay with a credit card. Affirm works with thousands of retailers and merchants, including stores in the apparel, travel, electronics, home and fitness categories. You can use Affirm to shop online or through the mobile app. Specifically, you can use Affirm to make purchases at partner store websites, through affirm.com, or inside the Affirm mobile app. You would simply shop for the items you want, then add them to your cart. When you're ready to pay, you can choose Affirm as your payment option at checkout. Affirm then allows you to choose your payment terms and complete the purchase. Okay, so how do we actually use Affirm in store? You can do so with an Affirm virtual card. When you're approved for Buy Now Pay Later with Affirm, you can choose to have the amount loaded onto a virtual Visa card that works just like a credit card or debit card for making purchases. To use your card in store, you can access it from the Affirm app or link it to Apple Pay or Google Pay. Now, how do returns work when using Affirm? If you have an issue with a purchase or need to return an item, Affirm advises customers to contact the merchant directly. You would then have to follow the store's policies for returns. In terms of what happens to your Affirm loan after making a return, there are a few possibilities. For instance, Affirm can cancel your loan completely if the merchant has finalised the return. If the amount returned to you is more than the loan, then Affirm can return this overpayment to you, but the result may be different if the merchant issues either a partial refund or a store credit in lieu of a refund. In that case, you would still be responsible for paying any remaining balance due on your Affirm loan, even if you return the item you purchased. There are, however, several benefits for using Affirm. First and foremost, it allows you to spread the cost of your purchase over time, which can be very helpful if you're on a tight budget. Affirm also offers transparent pricing, so you'll always know exactly how much you'll need to pay, and there are no hidden fees or charges. Managing your Affirm payment is hassle-free. Once you've made a purchase, you'll receive monthly statements detailing your payments and due dates. You can also manage your account through the Affirm mobile app or website, where you can set up the auto pay to ensure timely payments. Note there are no late fees, prepayment fees, service fees, or any hidden fees of any kind with Affirm. If you don't pay Affirm on time, they can report your account activity for instalment loans to Experian. If you do fall behind on payments or don't pay at all, that can show up on your Experian's credit report, ultimately hurting your credit score. You may also have trouble getting approved for new loans with Affirm in the future. Now, in terms of security, Affirm takes a number of steps to protect your personal data. This includes using encryption to secure data and conducting background checks for all employees. For your finances, there are some risks to consider. Though Affirm touts itself as an alternative to racking up debt, you still incur debt when you use this payment service. So in conclusion, Affirm is a great option for anyone looking for a flexible and convenient way to pay for their...
I believe again that people are gonna overdo it and they're gonna get maxed out again. Let's see, there was an interview with the CEO of Affirm. It's just that this guy doesn't inspire me.
Welcome back to Fast Money. Affirm shares soaring today, climbing back into positive territory for the week. The fintech stock now up more than 20% since a blowout earnings report last month. The company has plans to expand further over the next year. Our Kate Rooney is live with CEO Max Levchin from the Goldman Sachs Communacopia Conference in San Francisco. Kate.
Hi, Melissa. Thanks so much. And Max, thanks for being here. Great to see you in person.
Great to be here.
I want to get your take on the consumer. We had some big news yesterday from Ally Financial. The CFO talked about some consumer weakness, said that inflation in particular and the job market is really weighing on consumers. What are you seeing from Affirm's borrowers right now?
I have to say, we're not seeing that. I think, so not direct quote, but close to what I read in the transcript was that they noticed a deterioration of consumer credit quality, credit performance over the last few months. we have seen an improvement over the last few months. So our consumer, and we span a fairly large part of the US at this point, is not struggling to pay our bills. There are lots of structural reasons why we're very different. We're unsecured loans, much shorter term, always centered around point of sale. So it's a fairly different type of product, but apples to apples, we're not seeing it.
That's fascinating. Is that true across all income levels for you?
Yes. Of our users, yes.
Really? Wow. I mean, that's so different from what others in the card space have said. I guess other than Visa, MasterCard, who've also said the consumer's strong, that might surprise a lot of people.
So I think structurally,
I think he's got a lot to hide. He's not really saying the truth on everything. Yeah.
Always really good to remember, we are fundamentally advantaged. Very short term, relatively speaking. Every transaction is underwritten separately. Every transaction is priced for the risk it represents in the moment of underwriting. We are compensated for the risk we take, and as a lender, we do take risk, but we're very good at managing it, and we don't allow it to run away from us ever. And so our results are not an accident.
So I want to ask you about the Apple partnership. I know that there's things you probably can't talk about, but in terms of expanding, the lending base with Apple, I wonder, as you look at credit quality and sign up some of these big partnerships, how are you keeping that in check? Or is it really Apple sort of maybe in some cases being the bad guy and saying, no, you're actually not eligible to pay in $4 here for an iPhone?
On the Apple thing, super excited to bring it to life when that happens. Too early to comment on that beyond it, but you actually hit on a really key point. A really important reason why folks partner with us, from the littlest to the largest. We are, and really genuinely are, the right party to ask, hey, should I buy this thing? Not just should I borrow this money, but should I buy this thing, service, whatever? Because we are very honest when we tell you yes, and here's the rate, or no, we think you're overextended. We won't charge you late fees, we won't screw you, we won't kick you when you're down if you can't make a payment. We're on your side. So when we tell you no, it's a genuine, compassionate, you probably are overextending yourself. It is much easier to outsource that to someone like us, who will not charge late fees, will treat the customer right, than trying to do it yourself. And so we are the responsible lender.
Letting them down easy in some cases. I do want to ask you about interest rates. Big Fed meeting next week. What would lower rates mean for Affirm's profitability going forward?
Better growth. Like, our margin target is 3 to 4%. We delivered on that. Have been delivering on that for a very long time. Intend to deliver on that. That's the cornerstone of our profitability promises. But whenever, over time, not immediately, the Fed rate cuts trickle into our cost of capital, it will allow.
Look, I just don't trust them. I've had enough. Let's see what Wall Street Millennial is saying.
What's up, guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. Today we're looking at the fintech company Affirm, which was one of the hottest IPOs of 2021, and also ended up being one of the biggest bubbles. To say that Wall Street was enthusiastic about Affirm would be an understatement. They raised $1.2 billion at a valuation of $49 per share. When shares started trading, they immediately skyrocketed, almost doubling in value to $91. Unfortunately, the company has failed to live up to the hype thus far. The share price lost almost 2/3 of its value since the IPO bounce, and its current price of $42 a share is even less than the $49 offering price. In this video, we'll look at what Affirm does, why there was so much hype around the IPO, and why they failed to live up to expectations. Founded by former PayPal co-founder Max Levchin, Affirm is a leader in the so-called buy now, pay later space. They provide installment loans where you can buy a product today and pay for it with monthly payments over the course of 3, 6, or even 43 months. It's basically a way for people to live beyond their means. If there's an expensive item you want to buy but you can't afford it, you could use Affirm to push back the payments until your next paycheck. For example, let's say you want to buy Peloton's $3,000 treadmill, but you don't have $3,000 of cash sitting around. You could instead purchase it on credit through Affirm with $0 down. If you choose the 43-month option, you only have to pay $76 per month for the next 3.5 years with 0 interest. But if they don't charge interest, how do they make money? A traditional bank makes money from interest on their loans. Let's say you buy a $300,000 house on a 30-year mortgage. By the end of the 30 years, you will have ended up paying a lot more than $300,000 to the bank. This chart shows how much interest and principal you'll pay off over the 30 years. Over the course of the mortgage, you will pay $276,000 worth of interest, which is almost as much as the home's value. Even when the interest rate is relatively low, it adds up over time. In the case of Affirm's Peloton offering, they don't charge any interest. Peloton pays a fee to Affirm equal to a percentage of sales that use Affirm financing. The fees from the merchant compensate Affirm for bearing the credit risk, as well as their cost of capital. Peloton is effectively subsidizing their customers by paying the interest rate for them. This is an effort to boost sales of their products. In some cases, the merchant does not subsidize the interest rate. In these cases, Affirm will charge you an interest rate between 0 and 30%, depending on the size of the purchase, your credit score, and other factors. The average interest rate is about 20%. Americans are notorious for spending excessively on frivolous consumption. The US has one of the highest household debt to GDP ratios in the world, second only to Hong Kong. Any product that makes it easier to borrow money and make purchases beyond your means should have a lot of demand in the US. Investors viewed Affirm as an innovative and disruptive financial technology company, and that's why they send the share price doubling on the IPO day. But if you want to buy something that you can't afford, Affirm isn't the only option. You can also pay for it with a credit card and pay off the bill whenever you want down the line. The average credit card interest rate in the US is 20.5%, which is almost exactly the same as the rate that Affirm charges. On the surface, it doesn't look like Affirm is that innovative or disruptive. It's basically just an online credit card which offers very similar economics to the end customer. Despite this, Affirm has been able to grow impressively in recent years. Pre-pandemic, they processed about $1.3 billion of gross merchandise value, or GMV, per quarter. GMV is the value of goods for which they finance the purchase of. By the fourth calendar quarter of 2021, this had more than tripled to $4.4 billion. That's an insane amount of growth, and far beyond the growth of the credit card industry in the same period. So what differentiates Affirm? Traditional credit card lenders rely heavily on the FICO score. The FICO score is calculated by credit reporting agencies to determine the credit worthiness of consumers. Your FICO score depends heavily on your previous credit history. For example, if you had a home mortgage or auto loan in the past that you've defaulted on, your FICO score will be very low. If your FICO score is too low, banks will view you as a risky borrower and deny your credit card application. Even if you've never defaulted on a loan, you may still have a low FICO score if you're young, and you may have little or no credit history. This will give you a low or possibly no FICO score at all. This can put you in a catch-22. You need to have some loan history to have a FICO score, but without a FICO score, you can't get a loan in the first place. Affirm uses a more holistic approach to assess credit risk, which they claim allows them to approve 20% more applicants compared to the traditional credit card companies. They use artificial intelligence to assess how likely someone is to repay their loan, looking beyond just the FICO score. One example of this is looking at the type of product the consumer is trying to buy. For example, if a consumer who has never borrowed money before is trying to get financing on a $50,000 Rolex, there's a high probability that they're planning to resell it on the secondary market and default on the loan. On the other hand, if the consumer is trying to buy a $2,000 purple mattress, it's very unlikely that they plan to resell it. They probably just want to use it for themselves and will honestly pay back the loan. While a traditional credit card company might reject both of them if they had limited credit history, Affirm could approve the mattress buyer. Thus, a key benefit of Affirm is that they can give credit to consumers who would otherwise not have access to it. Also, unlike credit cards, they do not include late fees or other gimmicks in the fine print. This helps Affirm build trust with consumers. That all sounds great, but if Affirm is really an innovative fintech company with a superior value proposition, why has the stock declined by more than 60% since the IPO, wiping out $20 billion of shareholder value in the process? It boils down to two main reasons. Firstly, the company was obscenely overvalued, and secondly, they carry a tremendous amount of risk on their balance sheet. Since the beginning of the pandemic, Affirm's revenue has increased by 160%, which is very impressive. However, their net losses have also exploded. In the most recent quarter, they lost $143 million off revenue of $361 million. That's a net profit margin of negative 44%, which is pretty bad by almost any standard. As it turns out, they're fueling their revenue growth by spending massively on sales and marketing. During the same period, their sales and marketing budget has increased 20-fold. Even as their revenue increased, the sales and marketing as a percentage has still increased to more than 40% in the most recent quarter. This begs the question, is Affirm growing because their product is really that good? Or is it growing because they're rapidly burning their IPO proceeds to hire an army of salespeople to sign on new merchants? In the months following the IPO, investors started looking at these widening quarterly losses, and the stock started gradually moving downwards. but it looked like they were saved in August of 2021 when they announced an exclusive partnership with Amazon. Under the deal, Amazon customers will have the ability to use Affirm financing on products which cost over $50. Amazon is the largest US e-commerce platform by far, with over $600 billion of gross merchandise value. This massively expanded Affirm's ability to acquire new customers. But even with the Amazon partnership, the company was probably still overvalued. At the peak share price of $164 per share, Affirm had a market cap of roughly $45 billion. For the fiscal year of 2022, most of which includes the benefit from Amazon, they expect to make $1.3 billion of revenue. This put their valuation at about 35 times revenue, and they're still expecting to lose money. For comparison, Discover, which is one of the largest US credit card companies, trades at a forward price to earnings multiple of 11 times, which is a large discount to the S&P 500. On a price to sales basis, its market cap is about 3 times its sales, or less than 1/10 of Affirm's peak multiple. Banks and credit card companies generally trade at a discount to the broader stock market.
Those are the best videos from Wall Street Millennial. Also, there was buy now, pour later from Valuation. This is saying it's worse than a credit card. But anyways, I guess you guys get the point here. You can. Why is it worse than credit cards?
Have you heard about this new alternative to credit cards that's allowing them to get paid anywhere between 17 to 70% annually and avoid going through the Truth in Lending Act that came out to protect consumers from being destroyed by credit cards? Have you heard about this new thing? It's called Buy Now, Pay Later. Guess who's using it? Affirm, Klarna, Apple, PayPal, and they're making so much money and so attractive to the consumer because the consumer says, "Hey, this thing here is $1,000. I can't pay $1,000 right now." But guess what? This Buy Now, Pay Later allows me to pay only 25% right now, which is $250, and I get to pay the other in 3 payments, $250 over the next 6 weeks, and I own it. And in many cases, this is 0%. How cool is this? Then how do they make their money? Well, these companies like Klarna on the back end get paid 2 to 8% from the person that's selling the product. So, for example, Apple would send Klarna, this is a $1,000 product, they will give you $20 to $80. So that's how they're making their money. A couple different ways, but God forbid if you make a miss a payment, it goes to 30%. And by the way, more than 4 in 10 Americans who have taken out one of these buy now, pay later loans have made a payment late on one of those loans, according to a new survey from LendingTree, which is why 23% of BNPL customers have regretted financing a purchase this way. So why are people using it? I don't know, babe. It's a hot phenomenon. They're making a lot of money. Let alone on top of this, credit card companies today just increased their rates. It's the highest it's ever been. $3.57 trillion of available credit. Do you know banks, the largest banks in America, raised limits on 18.4 million credit cards in America in the first quarter of this year? It's up 22%. Why are they doing this? Made a lot of money, and then on top of that, they opened a record-breaking $89 billion worth of new credit card accounts in the first quarter of 2023, all because interest rates are increasing and they're finding another way to make money. I got so much stuff to share with you here right now, but this is concerning for me. I've been in debt before, and there are some quotes about debt I want to read, and then we'll get into the episode. First one is, "He who is quick to borrow is slow to pay." You know how I know that? I've been quick to borrow many times in my early 20s. Here's the next one for you. "If you think nobody cares if you're alive, try missing a couple of car payments." O. Wilson. They will call you and they will get their money. And last but not least, which is the heaviest one, Andrew Jackson. "When you get in debt, you become a slave." These companies are producing a lot of slaves today. If you get value out of this video, give it a thumbs up and subscribe to the channel. So let's get into it. If this is such a weird thing, why are people doing it? Well, because, listen, companies want you to spend money. The government wants you to spend money. That's how GDP goes up. The more money you spend, the better it is. Companies are making money. Do you think people are waking up in the morning saying, "Let me find a way to prevent you from getting into debt"? No, they own you. It's like a drug dealer. Get addicted. Spend the money. Get addicted. I make more money. Get addicted to this video game. Buy another NFT. Buy another this. The more you get addicted, the more money I'm going to be making. Fine. That's okay. No problem. You make a very good movie. Maybe I'm addicted to it. You make a very good book. I'm addicted to reading it. Fine. We can talk about that, but you as an individual have to make a choice so you don't fall for this trap, because it's very stressful. I remember being in debt $49,000. My credit score being 484, 495, 499. Something happens to men when you're in debt. You can't lead better. You can't be a good father, husband. your temper's short, your fuse is short, you're irritated with people around you because you're in debt and you don't know how to pay for it. You file a BK, you not file a BK, it's very stressful. So watch this. 70% of America's GDP is generated from consumer spending. 70% of the GDP is stemmed from you spending money. With interest rates at 5% and a much higher cost of living, consumers are getting squeezed. Personal saving rates are near record low levels. When you look at this chart, we are not saving a lot of money, but damn, we're spending a lot of money right now. So then the question becomes, you'll hear our politicians say, look at the GDP growing. It's been the best growth of GDP we've had in the last 7 quarters. It's amazing. It's record-breaking. Look at this chart right here. Q3 2023, GDP grew by 4.9%. How? Because you're contributing towards it. You're spending money. And you know what the president says? On behalf of the White House, I just want to say thank you for your spending money, whether it's buy now, pay later, credit cards. You're helping us have a very good number. Thank you so much for spending money. By the way, that's kind of like in MBS, Saudi Arabia, 42% of their GDP comes from oil. You, consumers, are oil to the U.S. economy. So let's take a look at some of this data from buy now, pay later. The market for buy now, pay later, some call it BNPL, an alternative to credit cards, whose popularity exploded during the pandemic, is expected to reach $4 trillion in 2030.
Well, like I say, there is a lot of companies now doing the buy now pay later, like he was mentioning Apple and PayPal. It's a very competitive environment. I would stay away from buying this stock. I might actually short it, and I don't recommend you guys to use the product or to buy the stock.